Good afternoon, everyone, and welcome to the Inside. We'll get started in just about 1 minute or so. We want to allow those in the queue the opportunity to go ahead and dial in. Thank you. Hello, everyone, and welcome to our Inside ETFs University webinar series. Today, we kick off part 2 of our 5-part webinar series, ETFs 201, How to Trade ETFs Like a Boss. I'm John Swolz. I'm the CEO of Inside ETFs and your host for today's webinar. Before I turn the webinar over to our 2 presenters, I did want to take a minute to thank you, the listener, for joining us and give a big thank you to Roger and Frederick for putting today's content together. I do also want to cover a quick couple of housekeeping notes to make your webinar experience better. The first thing you want to know is at the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer them live during the webcast, but if a fuller answer is needed or we run out of time, our speakers and sponsors will do their best to follow up. We capture all questions. You can expand your slide area by clicking on the maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the help widget. It has a question mark icon and covers the most common technical issues. An on-demand version of the webcast will be available approximately 1 day after the webinar and can be accessed using the same audience link that was sent to you earlier. As I mentioned, today's webinar is the second installment of our Canadian ETF University series. Over the course of 5 weeks, we will cover everything from ETF basics to more complex ETF issues like active ETFs, fixed income ETFs, and smart beta. But today, we're going to focus on how to trade ETFs effectively. You may have seen today's title of the webinar and chuckled a little bit or thought, what does it mean to trade ETFs like a boss? The answer to that is pretty simple. There are some basic do's and don'ts when it comes to trading ETFs. If you are able to master these as well as understand a few key stats, you really can trade ETFs like a boss and stop leaving money on the table. For the next 60 minutes, we're going to explore the ins and outs of ETF trading, leaving you with the core working knowledge of how to trade ETFs as well as to avoid many of the common pitfalls. I am truly excited for today's webinar as I could not think of 2 better presenters to cover ETF trading in Canada than Roger Chanduk and Frederick Vigier, both of the National Bank Financial Group. As a bit of background, Roger is in the global equity derivative sales at National Bank Financial. He joined NBF in 2010 and covers exchange-traded fund issuers in various capacities, including structuring, ongoing distribution, and trade execution. In addition, Roger covers a growing client base of institutional investors using ETFs. Roger leads the Equity Index Analytics team, which publishes regularly and enhances NBF coverage of the Canadian ETF and index fund managers. He holds an MBA from the Schulich School of Business at York University. And in addition to Roger, we're joined by Frederick Vigier, and he's a managing director at National Bank Financial. Fred leads the flow business on the institutional sales team in ETFs, listed options, and program trading. NBF offers a suite of client-centric solutions for ETFs, options, and direct electronic access. He also co-heads the ETF market-making team. The ETF group is a lead participant in the ETF market in Canada. The market makers are especially responsible for providing clients with liquidity in a broad range of Canadian and U.S.-listed ETFs. The team is also dedicated in supporting issuers with their current and new products. So we could not have 2 better representatives of the trading community than Roger and Frederick with us today. So with that, I want to turn it over to them. Roger, it's all yours.
Thanks for that introduction, John. So today, we're going to cover 3 broad areas to help investors get comfortable trading ETFs or placing orders to trade ETFs, and to clear up some misconceptions about ETF pricing and liquidity. So first, we're going to cover mechanics, and we're going to talk about sort of the initial creation of an ETF and how it comes to market. Second, we're going to talk about the liquidity advantage that ETFs present. And third, we're going to get into the nuts and bolts by talking about pricing and trading of ETFs. So understanding ETF mechanics. And before we get into detail, we should describe the structural uniqueness of ETFs and why trading them effectively requires some new type of expertise. So what is the key difference between mutual funds and ETFs? Well, I mean, their transaction structure. Now, we're all familiar with mutual funds where buyers and sellers interact directly with the fund to buy and sell units with cash. And in a subscription, the mutual fund manager takes cash and buys underlying securities. So every buy or sell accesses the underlying market's liquidity. Now, for ETFs are essentially mutual funds, but the main difference is that buyers and sellers interact with other buyers and sellers in the marketplace, or more specifically, a stock exchange. And on the exchange are market makers who provide liquidity in large size over and above the size posted by natural buyers and sellers. Now, these market makers are ultimately the parties that interact with the fund to create and redeem units as needed. Note that in the U.S., these market makers are called authorized participants. So if you listened to the 101 last week, you heard that term being used because these are the entities who are authorized to create and redeem. Whereas in Canada, and for the purposes of this webinar, we'll simply refer to them as market makers. The key takeaway from this transaction structure diagram on the right side is that for ETFs, there are additional layers of liquidity, which we will discuss. So how is an ETF created? Now, for a fund to list on a stock exchange, it is required to have some minimum level of assets. For example, on the Toronto Stock Exchange, that minimum is $1 million. Now, the designated broker, which is the lead market maker that agrees to partner with the ETF provider up front, will provide seed money by purchasing units directly from the ETF issuer through a subscription order. The ETF manager will take the seed money and go long the underlying securities. But remember that the market maker is long the ETF units, so to stay hedged from any market movement, that market maker needs to short sell the underlying securities. Now, in this example, as you can see, we assume a 5-stock equal weighted portfolio. And at $10 per unit NAV, the designated broker starts with 100,000 units before the opening bell on day one. So what happens intraday? Now, last night, the fund's NAV of $10 was based on the TSX closing prices of 5 stocks. So intraday, now let's assume that the market is down 5% overnight. Intraday on day one, the underlying securities prices start to float, and at every second in the day, our programs are tracking the bids and offers of the underlying and calculating fair value of the bid and offer. Now, in this case, it's 9,475 to 9,495, which is 2 cents wide. Now, let's assume that 150,000 units were sold on the first day. The designated broker sold 100,000 shares, and another market maker sold 50,000 shares. Now, on day two, that designated broker is flat because they sold their 100,000 initial units, which is, I should say, an ideal position because market makers typically don't like to hold large amounts of inventory. And now let's assume the other market maker now is short 50,000 units, so needs to subscribe for 50,000 units. Now, the fund's asset in this case, the fund's assets have grown to $1.5 million. So, this is just a good example, and it sort of sets the context of how an ETF is created and starts to grow. Now, so how does that subscription actually take place? Now, continuing with this example, the intraday fair value of the portfolio, as you remember, was 9,475 to 9,495. And we assume an investor bought from the market maker ETF shares half a penny higher than that fair value, which was on the offer at 950. The market maker immediately turned around and bought the underlying portfolio at 9,495. So the market maker is now short the ETF they sold to the investor and long the stock they bought. And in a traditional in-kind subscription, which is the method for most index tracking ETFs, the market maker will submit a subscription order whereby they deliver the stock they bought in exchange for ETF units to cover their short. So this is the traditional structure. And note that the market maker is not always subscribing and redeeming for every single trade. And it's only really when the market maker builds up a sizable position. Now, cash creations are available to market makers for many active managed ETFs and ones that have strategies that can be tricky to hedge for the market maker at all times throughout the day, such as ones with international exposure. Now, the only difference in this case is that instead of the market maker trading the portfolio to hedge their exposure to the ETF, like in the prior example, they are trading other correlated instruments or proxy hedges, which is depicted on the right side of the slide here. Now, when that market maker subscribes, instead of delivering the portfolio, they need to sell their proxy hedge for cash and deliver the cash, not the securities, in exchange for the ETF. Now, we think this is an important concept when trading innovative strategies or asset classes because you can rest assured that market makers are using various tools to offer the most efficient and favorable pricing. So that kind of gives you an overview of...
I wanted to jump in there real quick with a question for you, though. I mean, how often does this kind of create, redeem happen from the market makers, maybe throughout the day, kind of throughout the life cycle of a trading day? How often are they creating and redeeming ETFs?
Yeah, that's a good question because I guess many people believe, and we get this question a lot, many people believe that every single trade results in creation or redemption. So people come to us and say, well, why can't we just get NAV? You're going to create with that trade anyways. Well, in practice, that's not the case at all. And is only occasionally the case for really large institutional size trades where we are facilitating the trade for NAV or for the net asset value. So usually it's not the case. Now what we do is we review our inventory holdings on a daily basis. Now that might not be true for every dealer, but we do it on a daily basis. We look at our inventory and we'll transact only when we've either built up a large long position or when we believe we'll be short a position for a while, so we'll subscribe for it. And it's important to know that all ETFs have what's called a PNU, or a prescribed number of units, which are the increments that we're able to subscribe and redeem for. Most are 25,000 shares, 50,000 shares, or even 100,000 shares. So in most cases, we are not going to transact until we've built up an inventory position of more than those increments. Does that answer your question?
Yeah, absolutely, because I think it's one of those things I would agree with you where people think it happens more frequently than it does. So thanks for clearing that up.
Absolutely. So ETF liquidity. Liquidity is one of the most sort of misunderstood concepts. And certainly it's more and more understood as ETFs start to get adopted more, but still misunderstood. And we'll try to simplify it in the next few slides to dispel some myths, but also to sort of let investors identify or help investors identify when there are advantageous liquidity scenarios. So the presence of a stock exchange adds extra layers of liquidity when compared to mutual funds, and we all know that. Now the first is what the industry calls natural flow, which are bids and offers posted in the marketplace, or what we call on-screen, because these are entities that simply want to buy or sell units. Now most of these are retail investors, discount broker investors, or institutional investors. Now the second is our market makers who are typically broker-dealer trading desks who quote bid and offer in large size around fair value. Now for many ETFs, the natural on-screen activity, as depicted with the dark blue circle, can support most trades. But for larger size, market makers stand ready to provide liquidity. And the third layer is the market maker's ability to subscribe and redeem with the ETF. Now, this level is the same as it is for a mutual fund, of course, assuming the same underlying. So as you can see, ETFs have a similar subscription and redemption ability or function to access the underlying market, but also two additional layers of liquidity that don't really exist for mutual funds. So the trading tip related to this is that investors should learn to identify and take advantage of the different layers of liquidity, or that on-screen bids and offers, because they can oftentimes be tighter than fair value, or offer more favorable prices than the fair value of the ETF itself. Now, of course, this is a great benefit, excuse me, but one issue is that because ETFs trade on an exchange and there is that on-screen liquidity, some investors only look at that on-screen liquidity, simply the way they do for a stock. Investors pay attention to volume, which is usually measured by average daily volume, where large amounts of sellers relative to average daily volume pushes the stock price down, and large amounts of buyers relative to average daily volume pushes the stock price up. Now, for ETFs, that's just not the case. As we showed on previous slides, ETF pricing is simply based on fair value, which is based on the underlying securities, bids, and offers. So you really have to look at the underlying portfolio. Oftentimes, even new ETFs that haven't traded much and have very low average daily volume can support tens of millions of shares traded at any given time without impacting price. Now, in this case, the trading tip we have for you is that ETF volume really does not equal liquidity. You need to assess the liquidity of the portfolio. Another tip is that there are tools out there to help you do that. One is Bloomberg's implied liquidity measure, which tells you the number of shares or dollars you can trade of an ETF without impacting the underlying market. Now, National Bank's ETF analyst also has some tools. So certainly there are tools out there for you to be able to assess the true liquidity of an ETF. So here's an example of this actually playing out. MUB is a Mackenzie bond ETF that was just over about a year old. On September 20th, MUB's ADV was about 60,000 shares per day, and bid offer was tight, and the best offer was 20.87. At 10:29 a.m., a retail desk came and bought from us 435,000 shares in one block, 1 cent inside or better than the offer price. Now, this was 7 times the average daily volume. Now, for a stock, if you tried to trade 7 times average daily volume, there would have been massive price impact, and it would have taken you much longer to complete the trade, if at all. But in this case, right after the trade, if you look above the red rectangle there, you'll see the quote remained at 20.83 to 20.87, and the market was not impacted at all. So the point here is that average daily volume really was irrelevant. Now here's another example. So VAB is a Vanguard ETF that is almost 7 years old. So it's a bit more mature and traded a bit more actively at 400,000 shares per day average daily volume. But on February 27th at 2:48 p.m., an institutional investor bought 5.3 million shares from us in one block, and they were able to get it done at the offer price, $24.85. Now, this was 13 times average daily volume. Now, for a stock, trading 13 times average daily volume would have had massive price impact. But in this case, if you look again right after the trade, you look above the red rectangle, that bid-offer spread was 20.84 to 20.85, so the market was not impacted at all. And because there is a market maker who is accessing liquidity of the underlying market near fair value, now this kind of size is really not a concern. Now, to wrap up our liquidity section, because we believe we've made the point, we've kind of made the point when looking at individual trades. To wrap it up, we thought it would be it would be useful to take a step back and look at this on a macro view. There are theories out there that ETF trading is causing volatility because the underlying markets are not liquid enough to support all that ETF trading. But if you look at the stats, if you look at the numbers, here in this case, if you look at the gray line, in 2017, equity ETF volume was only 4.5% of stock market volume in Canada. So obviously that's really a small portion compared to what the underlying market can support. Furthermore, of course, the real way ETFs impact the underlying market is through the subscription and redemption mechanism, as I explained. And you can see, based on the red dotted line at the bottom, the absolute subscription and redemption flow is even less, is only 1.4% of stock market volume. Now, this further strengthens the point that, at least for Canadian equities, the underlying market is very, very liquid compared with ETF volume. So that sort of wraps up the liquidity section. And before I pass it along to Fred, are there any other questions?
Yeah, actually, we did have one come in that I want to touch on real quickly. And they want to know, when they're looking at two ETFs, kind of when does volume become important choosing between those two different ETFs?
Yeah, so, I'm not going to say that ETF volume is totally irrelevant all of the time. ETF volume is only really relevant when there are lots of sort of natural on-screen activity, and you're going in and trying to trade small size. So if you're trading, a few hundred shares, and you know that this is a very actively traded mature ETF with a lot of market participants buying and selling, that volume could be relevant for you because you could potentially get a price that is more favorable than what the market maker is quoting. Now, of course, the larger the trade, the less that matters, because for really large trades, most or all of your trade will be captured by the market maker at fair value anyways. So the larger the trade, the less that matters.
Thank you. That's very helpful, and I appreciate you taking the time to get that answer for us.
No problem.
Are we ready to move on? Are we bringing Fred in from here?
Yeah. So we can pass it along to Fred now.
All right. Thank you, Roger. Well done. Now let's look at the role of the market makers. There are different liquidity providers in the ETF space. Market makers are the only ones that quote a two-way market around the fair value of the ETF. Again, the only difference between the designated broker, or the DB, and the other market makers is that the DB seeded and got some ETF units in return. But all the market makers receive the basket composition and are able to quote the ETF around fair value. HFTs, or high-frequency traders, do not necessarily know the ETF fair value, but they can provide liquidity by trying to capture the bid-ask spread, by buying on the bid and selling on the offer, or by trying to take advantage of maker-taker exchange fees. And then the other participants are retail and institutional orders in the book. Now let's talk about electronic quoting. Everything is done electronically with programs and algos. Market makers receive the portfolio composition from all ETF issuers, and then they load the data into their programs. Market makers depend on various input to electronically calculate intraday fair value, like exchange quotes, bond data, futures quotes, foreign exchange quotes, etc. The goal of the market maker's electronic program is to keep the tight spread around fair value and to manage risk. trading tip would be to avoid trades at the open and avoid using market orders. The fair value bid offer of the ETF is determined by bid offer of the underlying securities plus other costs. Examples would be if an asset class is illiquid, it might be harder to hedge. If the issuer charges fees for creating or redeeming. Market makers will also adjust for uncertainties. For example, if there's a large or unexpected intraday portfolio change, or if there's a stock in the portfolio that is halted. We would also account for if we get bad market data. For example, right now the bonds are closed. They closed early for the holidays, but we are still quoting bond ETFs as we speak till 4 p.m. We just adjust the spread to account for that because we can't hedge. Trading tip, remember that the ETF trading costs are externalized to the buyer through the spread, unlike mutual funds where the trading costs occur in the portfolio and impact all holders. In this slide, we're comparing two scenarios where the issuer could decide to launch with a $10 NAV or a $50 NAV. The spread looks tighter on the $10 NAV at 2 cents per share. Sorry, at 2 cent spread, but it's the same as 10 cents on a $50 ETF. So when you're analyzing spreads, look at the spread in beeps and not in cents. In this scenario, both ETF are 20 beeps wide. The next slide here, we compare two ETF that have exactly the same underlying. The first day of trading for ETF 1 and ETF number 2 has been trading for 1 year. For simplicity, let's assume that they both have the same fair value of 9.995 to 10.025. So market makers will be quoting 9.99 to 10.03, not tighter than that. The main difference with ETF 2 is that there is natural flow inside the market maker's bid-ask, which tightens the spread. You see on the ETF 2, you have an institutional buyer of 50,000 shares. He's bidding $10. And you have retail bids also, and you have retail offers at 10.01 and 10.02, resulting in a penny spread for ETF 2. But the market makers are quoting the same thing, 9.99 to 10.03. For mature products, there's often liquidity inside fair value. The one-year-old ETF spread is 1 cent wide, and then 4 cents for the new ETF. For some products, ETFs can trade all day between buyers and sellers without the market makers ever trading. So this means without the underlyings or without the fund being touched. So no create redeems. If you look at ETF 2, all the trades between $10 and 10.02 don't involve a market maker. All flow inside. So the trading tip here would be to pay attention to market depth. Always use limit orders. And when in doubt, contact your trading desk. In here, we look at various order types. A limit order is when you put a specific limit price on your order. This is the type of order that should be used instead of sending market orders. You can use aggressive limits. For example, if the ETF is 10 to 10.02, you can send a limit order to buy 40,000 or 100,000 shares and pay 10.03 to make sure that your order gets fully filled. Or you can also choose to put 10.01 as your limit and try to get filled mid-market. Another order type is the RFQ. That stands for request for quote. It's mostly used in the US by institutions that want to reach multiple liquidity providers at the same time, or by asking them to quote on a specific order. Another type of order is the NAV order, or the net asset value order. The client wants to get filled at the net asset value. The market makers will usually charge a fee for these kind of orders to cover any exchange fees or other fees that they might have. And then another type of order is an agency create. It's also called an in-kind create sometimes. The client gives the market maker the underlying basket in exchange for the ETF. An example of this could be an advisor that wants to exchange 10 preferred shares in exchange for a preferred share ETF. So in this example, the market maker would work with the issuer to facilitate this trade for the advisor. So a trading tip: for best results, trading method should depend on the size of the order and trading capabilities. So when in doubt, call your trading desk or your market making desk.
Hey, Fred, can I jump in here real quick with a question for you that popped up from the audience?
Yep.
And I think it's something that they're kind of always curious about. And it's, how do I know that I'm getting a good or a fair price on my ETF?
That's a good question. Basically, IAs can look at, for example, at last night's net asset value and then compare with the current market conditions and looking at the underlying assets. For example, if you look at an ETF, last night's NAV is $15, and the markets are pretty flat. You look at the futures and other things, and the markets seem to be pretty flat. If the ETF is 1560 to 1565, well, then you might think something's off. But all the market makers are all competing against each other, so to gain that market share. So if ever one market maker is off and the other ones have the proper quotes, we will end up trading against each other and bringing everything back in line. Also, we're all competing for the flow. So if we see that another market maker is trying to make 2 cents per share on an order, we will usually step in and tighten that up and bring it to less than a penny. And one thing to understand, we quote 600 ETFs in Canada electronically. We set the spreads early in the morning, and we work with the exchanges. So if ever an ETF is to open away from NAV, or if they see that anything weird about where the ETF is opening, daily we talk to them, and we make sure that ETFs open near the fair value.
So it sounds like it's one of those things, just as an advisor or a trader, you just kind of have to be cognizant of what you're doing as you go to place your trade, and make sure you're kind of looking at what's going on in the market, where things were yesterday, and that should kind of guide you as to where you'll end up on any given day.
Correct. If you look at an ETF that's actively trading, it's a penny wide, and it's trading around that throughout the day. Put a limit order, pay offer if you want to get in there. But you don't really have to worry about anything. If you look and the ETF is maybe 10 cents wide, it's not trading actively, maybe put a limit order, try to see if there's other natural sellers. Try to maybe to get in there mid-market, wait and see. Maybe there's somebody bought it a year ago lower and he's willing to sell it mid-market. You don't necessarily need to interact with market makers all the time. Market makers will be the ones setting like the goalposts to where the big liquidity is, but most of the time, depending on the asset class, there will be liquidity inside the market makers' quotes.
Great.
And then basically the last slide, it's a couple of things that you need to remember, very important things when we talk about ETFs. So the ETF is basically just the investment vehicle that gives you access to the asset class. The ETF price moves all day around fair value, like we demonstrated earlier. Throughout the day, there's a fair value bid and a fair value offer. So you have two fair values, or some people like to call them NAV throughout the day, but we call them fair value because there's only one NAV and it's at the end of the day. Investors should take advantage of natural flow, like I just explained, because you might be trading against retail or institutional flow. And by using limit orders, call your trading desk for advice. The last point is just basically explaining how net asset value are calculated. For North American equity ETFs, net asset value is based on the closing price, so 4 p.m. on the TSX. For bond ETFs, net asset value is based on the bid or the mid of the underlying bonds at 4 p.m., so depending on the issuer. And then for commodity ETFs, the NAV is based on the future settlement price. So, for example, crude oil that settles at 230, that will dictate the NAV for ETFs that follow that asset class. If there are any more questions, we would be happy to answer them.
Yeah, absolutely. So there's definitely some questions that have come in. So the first one is related back to what you were just saying about bond ETFs, right? We know that bonds typically trade over the counter and they're not on exchange. So how are market makers quoting bond ETFs?
That's a good question. We get it often. Even if bonds are over the counter, we still get electronic quotes that feed our models, so that we know exactly where we can trade the underlying bonds. So we get electronic quotes that feed our programs, and it allows us to know where the liquidity is on the underlyings. It's a bit different, like if we sell an equity ETF, right away the program will turn around and buy the 40 stocks or the 50 stocks that are in that index. For fixed income, the market maker would hedge, but he would probably not hedge with the bonds right away. He would probably hedge directional risk, interest rate risk, and then credit risk. And then he would start trading the bonds. But for example, if you're hedging a bond that has an ETF that has 1,000 bonds in there, it's slightly different when you talk about fixed income, because the issuer will have a creation basket and a redemption basket. So basically, it's going to be 30 bonds that you're going to be exchanging with the issuers, as opposed to 1,000. So it's slightly different, but again, the process is the same. The fact that bonds are over the counter, it just makes the process more manual and slightly longer, as opposed to buying a basket of stocks in milliseconds right after selling the ETF.
Yeah, thank you for that. So I want to encourage the audience again, if you do have questions, please go ahead and submit them. We'll do our best to get to all of them. Another question that came in is in regards to the hedge. So I don't know if that was specifically referring to bond ETFs or ETFs in general, but how do market makers just hedge their book in general?
Well, again, like Roger and I both touched on it. It would be too complicated for a market maker to, for example, to only partially hedge some of the trades that they do, because then it leaves you exposed with risk. The role of the market maker is to minimize risk as much as possible, especially when you do 10,000 shares a day. So basically, every time that a market maker sells an ETF, and it's an in-kind create that he needs to do with the issuer. When you sell, for example, XIU, you're selling the ETF. You will need eventually to buy the 60 stocks, because this is what you're going to be delivering to the issuer in exchange for the ETF units that he will give you. Slightly different, like I just touched on with the ETF for fixed income. Slightly different way of hedging, obviously, because you will be delivering a custom basket to the issuer. And then international ETFs, pretty much the same thing. We would be hedging with proxy futures, anything that we have available that will create the less risk and the biggest correlation. Depending on the ETF, different ways that we can hedge, but at the end of the day, once we sell a big portion of an ETF, we'll look to create units the next day and to get out of our hedge if it's not something that we're delivering to the issuer.
Thank you for that. And Fred, along those lines, one of the things that you tend to see a lot, because you had mentioned kind of international ETFs and emerging market ETFs, sometimes they can have a little bit wider spread. Is that due to the hedging, or is there something else in there that might be pushing the spread wider on, say, an emerging market ETF or an international ETF?
No, I mean, it's a combination of different things. The market maker will always be as wide as the underlying asset, and then as we touched upon earlier, as the ETF becomes more popular or there's more players playing it, then you will have that inside liquidity. But no, I mean, before the issuer launches an ETF, obviously they are in contact with their DB, and they do ask the DB to give them an indication of how the spread will be. Obviously, if an issuer has an idea of an ETF and the market maker comes back and says we won't be able to be tighter than, for example, 20 cents on a $10 ETF, nobody wants that. The issuer doesn't want that. The market maker doesn't want that. The investors don't want that. So like I said, the market maker will always be as tight as the underlying securities, but until the natural buyers and sellers come in, I mean that will be the market, because like I said, when you sell the ETF, you need to turn around and pay offer on your hedge. So market makers cannot be quoting tighter than what it's worth, because then you end up locking losses every time you hedge. Yeah, different combination of things that makes the spread. Other fees as well, if the issuer charges for creation or redemption. If, for example, the market maker calculates 10 cents wide fair value with the underlying securities, if the issuer charges 2 cents, well, you need to account for that, because for international or emerging ETFs, basically some of them, instead of delivering the basket, because it's obviously harder to get for the market maker, you would actually deliver cash. So that's where the money comes in, that the issuer charges the market maker, because they will be incurring exchange fees when they get the money from the market maker to go and trade the underlying securities themselves. And then that is why there are fees that usually are eaten by the market maker on North American securities.
Thanks. It's good to understand. Oh, go ahead.
Well, I just want to add that there's also FX. If there's currencies that you need to trade, that could add also to the spread. So there's different things, obviously. Stamp fees on certain exchanges in certain countries, they charge for stamp fees. So all these fees are to be considered when looking at the spread.
Yeah, absolutely. And I think the nice thing when you think about that is that you see that they're in the ETF there. It's in the pricing. It's not necessarily a hidden fee. It's paid when you get in and out of the ETF, which is nice. So we do have time for a few more questions. And one question that we get, and I think this happens regardless of where you are in the world, is what is the minimum size when I want to reach out to a trading desk or a market maker? I think people think that there has to be a specific size before they can actually reach out to a market maker. Would you guys have a recommendation there, or how do you guys handle that situation?
I mean, we have
I think. Sorry, go ahead, Rick.
We have IAs that call for 5,000 shares. When the spread is like a penny wide and there's 50,000 on the bid and ask. So I mean, that obviously we don't need to get these calls, but it really depends on the ETF. It really depends on the asset class. You need to try to see where the market makers are quoting, and then judge if there's liquidity inside, or if, for example, if you can look at the screen and see 50,000 shares on the bid and offer 2 cents wide, you see that as a market maker, and then you see smaller size inside, so you know that you're actually taking advantage and trading it inside what it's worth. But I mean, some ETFs, 10,000 shares, it would be good. You should call your trading desk if you see that the spread is wide. You might call a market maker. You might be asked to sell. But for some ETFs, like equity ETFs that are widely traded, I would say, look at the screen first, and maybe 50,000 shares, 20,000 shares on some ETFs. It's worth calling and trying to see if you're actually paying offer, for example, if when you're buying or hitting the bid, if there's not enough liquidity. Sometimes market makers will post 50,000 shares, but the program will reload. So like I said earlier, by putting a limit order, if you're buying 70,000 shares and you only see 50,000 on the offer, put that price as your limit price, and then you'll get your 50,000 that you saw on screen, and then the program will probably reload and fill you on the 20 in a microsecond. Reason why we're not showing 1 million shares on the bid and offer at all times is because if we get bad data or if we lose connectivity to an exchange, if our orders stay on the board and the market moves up, well, then another market maker might lift our offers, or other people might transact against our orders, and if we don't have control of those orders anymore, then there's too much risk for us. So like I said, put limit orders, call your trading desk. If your firm has a market making desk like ours at National, I mean, we take many calls throughout the day, and it's our pleasure to help guide the advisors and anybody that asks questions about ETFs.
Now, Fred, I just wanted to add to that. There are, I think, also some other scenarios where it would be helpful to call the trading desk, like if you wanted to do things that were a bit different, like switches, or you were trying to switch from one ETF to another that had relatively similar exposures. A trading desk might be able to help facilitate both legs of that transaction at more favorable prices than what you see on screen, even if it is not necessarily a large size. So, if you're trying to achieve different types of trades and you need some advice, just call anytime.
Yeah, that's actually a good point, Roger. I mean, for example, if you're invested in an ETF and that's currency hedged, and you want to switch to the same ETF, but just like take the currency off. Some issuers offer both currency hedge and non-hedge. When you're switching from one and another, definitely call your trading desk and go through a market maker, because all the market maker will have to do is basically an FX trade. So you will be able to trade pretty much close to inside the bid ask. Another example is if you're switching from one issuer to another issuer and it's the same underlying basket. If the market maker doesn't need to go and pay offer or hit bids on the bonds or on the equities or anything, then there's less risk for the market maker. So then, we do improve on the bid or offer on one of the legs when you're switching from ETFs, and the market maker does not need to actually trade that basket.
So, guys, I think we have time for one quick question, and this is one that I think is relatively simple to answer, and it's they want to know, why should I not trade at the open or close when it comes to trading my ETF?
I would say avoid the open. The close, you can trade till 359.59. That's not a problem. I know a lot of people say open and close, but the close is fine. I mean, we'll be able to hedge unless it's a very, very large transaction. But let's say avoid the last 2 seconds of the day. But even if we're still there, unless you really have to do it at that time, I would say avoid the open, because by the time, for example, a U.S. Underlying ETFs, we need to wait for 9:30 to get all the quotes to come in and tighten the basket for the underlying U.S. stocks and Canadian stocks. Because when stocks are in an opening mode, you basically have the same price on the bid and ask. But until the market opens and then you have a bid and an offer, our programs, basically, we don't know if we're going to be buying or selling and if we will be able to participate in the opening auction. So obviously on the open, we need to protect ourselves. So basically, I would say avoid the open or put a limit order that you're comfortable paying. But if you think the market's going to open and then just rally, meaning it's going to move up, and you want to be the first one in, obviously, you know, put the order you want to put. But I would say if you really want to just take your time and get into an ETF and accumulate a position, I would say avoid the open, because sometimes the ETF can open 5 or 10 cents rich, not because we're making 5 cents, it's just because we don't know at what price we will be able to hedge. So I would say avoid the open, let the underlying securities come in and go tighter, and then place your order. At least you'll know you're getting a fair price on the open.
Well, Roger and Fred, I want to thank you guys for your time. I know this can always be a little bit of an intimidating subject matter when it comes to ETFs, so I think you guys really broke it down, made it simple to understand. I want to thank the audience for taking the time to dial in and join us today. I also want to thank them for submitting their questions. It does look like we are out of questions at this time, so we'll be able to give people a few minutes back in their day. But I hope you can all join us again next week at 2 p.m. as we continue our Canadian ETF University with ETFs 301. Be smart on smart beta, equity factor ETFs explained, where I'll be joined by Chris Dahl of Invesco ETFs. Again, thank you to Roger and Fred for joining us today. Big thank you to all the attendees again for dialing in, submitting their questions. We truly do appreciate it. And I would remind everybody that if you like what you heard on today's webinar, or you're interested in learning more about ETFs or how to invest with ETFs, be sure to sign up for our first ever Inside ETFs Canada conference. It'll take place this June 21st and 22nd in Montreal at the Fairmont. Again, that's the 21st and 22nd of June down in Montreal. It's Inside ETFs Canada. And you can register on the web at www.insideetfscanada.com. Again, that's www.insideetfscanada.com. For all of us here at Inside ETFs, thank you. Have a great day, and look forward to hearing from you all next week. Thank you.